Here's the problem. You got to control what you can't control. I think that is one of the biggest things, the gift that keeps on giving. We cannot control the stock market. We cannot control interest rates. We cannot control a lot of things, but there are a few things that we can control. Like number one, Al, is how we invest, I guess.
Yeah, I would call it the type of investor. And there's basically two types. I guess you can boil it down. There's the long-term investor. So that would be someone like Warren Buffett, those that pick a good portfolio. Maybe they rebalance as appropriate, but they kind of stick with it. And then there's the market timers. It's like, oh boy, market's too high. I'm in, I'm out, I'm in, I'm out. So you got to pick which kind of investor you are. Let me give you a hint. The data shows from decades of research that people that are long-term investors tend to do a little bit better.
But that's not saying if I'm a market timer, I can't do better, because there's a lot of market timers that do a phenomenal job. We're just getting everyone in the mix here today.
Yeah,
then you got to look at your allocation too, right? So, all right, well, we're looking at time frames. Am I a long-term investor? Should I time the markets? But then, all right, well, what's my allocation? How much money should I have in stocks and bonds? You can control this. This is your risk capacity or your risk tolerance. How much volatility do you want to have in your overall portfolio? But I think more importantly, Al, is that people need to understand how much volatility should they have in their overall portfolio to help them achieve their goals.
Well, that is correct, Joe. And you can control how much you're allocated in stocks and bonds. You cannot control the market itself, but you can control your exposure. Bonds are safer. If you need more safety in your portfolio, if your planning allows for more safety, then have more safety. We're big believers in having as much safety as you can in your portfolio to accomplish your goals.
One of the things, too, that you want to look at is what you can control is fees and costs. Fees and costs is not the end-all, be-all, but if you're paying 3% versus 1%, or if you're paying 1% versus 50 basis points, over the long term, that could have a huge component on your overall portfolio performance. And then I think finally, let's go to Big Al's favorite topic, is taxes. This is where people really drop the ball. If you can figure out a way to save money in taxes, put more money back into your pocket versus Uncle Sam's, guess what? You can take less risk in the portfolio because less money is going out of the portfolio to pay Uncle Sam the taxes. You can control this if you do the right planning. And I think this is where, again, Al, people kind of fall short.
Well, I think so too, Joe. And really, if you think about it, if you've got money in a Roth IRA, you've got more control. So when you look at your retirement income, what your needs are, if you've got only money in your regular IRA, your regular 401k, and you pull money out, of course, it's fully taxable. Maybe you've got Social Security, maybe you have pension, fully taxable. Maybe you have money outside of retirement plans invested for dividends or interest income, fully taxable. So it's a matter of figuring out a better way. So first of all, getting money to a Roth IRA is important. So when you're in retirement, you start taking money out, that's tax-free. Then it's tax efficiently investing those assets that are outside of retirement to make sure you get capital gains, or maybe tax-free income like municipal bonds. Maybe you've got some real estate depreciation nets against it. It's really not what you make, it's what you keep.
Alan, you are correct, sir. It's controlling the things that you can't control is probably one of the most important things of building an overall elaborate retirement investment strategy.